Welcome everyone to our federal budget update for 2021. Today you're going to hear some insights and analysis from the RSM team and our panel of top expert commentators. Before we start, I'd like to acknowledge the traditional custodians of the land we're all meeting on today. In my case, the Ngunnawal people, on whose land this studio is located. RSM acknowledges and respects the continuing culture and contribution made to the life of our country, cities and regions by the First Nations people. Welcome, my name is Andrew Sykes and I'm a Director of RSM's Business Advisory Division. Joining me in the studio today is Paul Bongiorno. Paul's a veteran political journalist and commentator with over 30 years experience. He's hosted TEN's Sunday morning show, Meet the Press, and in more recent times has been a regular contributor to the Saturday paper and commentator on ABC Radio. Joining us online today, we also have Effie Zahos, Steve Healy, and Serena Lacey. The team at RSM has been working overnight to produce our budget alert. If you haven't already downloaded this report, we encourage you to go to the comments section and you'll find a link in there where you can download our budget alert. I encourage you to download this budget alert. It'll give you all the information you need to understand what's happened in the budget. We'll also have time for questions today. You'll notice a Q&A function there on your Zoom screen. If you enter questions in that Q&A after our formal panel component is finished, we will address those questions. If you want to address a question to a specific panelist, just put the name in the question and we'll do our best to answer them for you. Firstly, I'd like to introduce Steve Healy. Steve's a director of RSM in the Tax Services Division. He's a chartered accountant with more than 25 years experience. Steve's located in Brisbane and he provides strategic advice on local, international, corporate tax matters with a focus on mid-size and privately owned businesses. Welcome, Steve.
Thanks very much, Andrew, and welcome everybody. So just to kick us off, I've got a couple of slides, a couple of poll questions I'd like to run past everybody. Not sure how many people have had the opportunity to digest the budget in full yet, but just interested to get everyone's thoughts on how you grade the budget on a scale of A to F, obviously F being really, really bad and A being really, really good. So if you could take just a couple of seconds, that would be great. So hopefully those responses are coming through. Okay, so we might just draw that poll to a close. So we can see there that the majority of people are giving it a B. That's fantastic. That really aligns with us. We gave it a B as well. Next, to the extent some of you may have had the opportunity to look at some of the detail and some of the key measures, just like to do a quick poll to see which of those measures has the most impact for you and your business. If you could just take again a few seconds just to do that. Okay. Appreciate it takes a little bit longer because there's a lot more words on this one, but if we can wrap that one up about now, just to see how we've got to. So again, a really interesting one, particularly I'd suggest the orange line in the middle. So without any further ado, thank you for that, really appreciate that. And this is an interactive session to the extent we can make it. So as I said, we gave the budget a B. I think it's a good budget, it's a responsible budget, it's clearly an election year budget, it's a pre-election budget. So what we did is we looked at it from different segments in the market and different taxpayer sectors as well. So we're going to go through at a very high level at some of the more significant impacts, certainly from a corporate and an SME perspective. I think that the big thing here is the further extension of the temporary expensing and the loss carryback rules to 30 June 2023. It's a very good initiative, and I think in the current environment to encourage spending and capital expenditure, it's a very, very big tick. And that applies both to corporates and SMEs. The loser there from a corporate's perspective, I guess, and an SME perspective, is those of us who carry on our enterprises through non-corporate structures. Unfortunately, you won't be able to avail yourself of the loss carryback rules, but of course the temporary expensing is still there. So it's still a big tick, I think, in my book and in our book. Moving down to superannuation, and I'm not going to, Effie's going to deal with this in a little bit more detail, but I think fair to say we gave it a C. A lot more could still be done in the superannuation environment, but we did see some positive outcomes for retirees, for first home buyers, and for casual employees. But as I say, I'll leave that to Effie in a couple of moments. If we turn quickly to individuals, there's really, it's a nod to simplicity. So two kind of core measures, I guess. One, and both targeted probably at lower income taxpayers. One is in relation to self-education expenses, where we're seeing an abolition of the non-deductibility of the first $250 for self-education expenses. As well as that, we've got an increase in the Medicare levy low income threshold. So again, welcome news. Winners, no losers on the individual side. There's been no increase in marginal tax rates. And generally speaking, I think the individuals in the taxpaying community have come out on top. Turning to the international side of things, we've given that an A. And now that comes from a couple of different things. One thing that we have seen, and very, very welcome, is some certainty around individual tax residency. You may recall last year we had the same thing around corporate tax residency. And this has been an area of contention in recent times with a couple of court decisions, and more significantly, the ATO's interpretation of that precedent. So what we've got now is we've got a bright line 183-day test for determining Australian residency, and that's a really welcome initiative. As well as that, on the international side is large corporates that are carrying out R&D and developing technology in Australia. I think the budget contains a number of measures that when we look at them combined, it's really good to see that we're encouraging technology investment and exploitation in Australia. We're trying to keep our technology and our IP here. And one of the key things that contributes to that out of this budget is the new patent box regime. This is a regime that's not necessarily common across a lot of nations, but there are quite a few nations that have them, Singapore being one of them, for example, and the UK being another. What it means is that if we develop IP and patents in Australia, if a taxpayer does that, then the income that derives from the exploitation of that IP will be taxed at 17%. And out of interest, that's the same tax rate as the headline corporate tax rate in Singapore, although I would note that the tax rate under the patent box system in Singapore is 5%. So we've still got a way to go, but it's an excellent start. The digital economy, as I mentioned, there's a lot in the budget around technology and enabling and facilitating the digital economy and the growth. The winners here are tech businesses. And what we have seen, or what we are seeing, is intangible assets, depreciating assets, being kind of more aligned to how we treat tangible assets. And that's really down to the concept of self-assessing effective life. Historically, intangible assets have fixed legislative effective lives. We will now have the ability to self-assess those, although that will come in post the expiry of the extension to the temporary expensing of depreciating assets. Tax reform, this is a soapbox thing for me. I can't help myself. It's not in our budget paper. This is just me. The winners, there aren't any. The losers, it's all of us. We do have a tax system that's not fit for purpose. It's a last century tax system in a modern economy, and it's something we desperately need. Unfortunately, the budget is yet an opportunity lost. That's enough about my soapbox. Just turning quickly to industry, the measures in relation to the tech sector, we've given an A. There's a lot of funding and other initiatives that are directed to the new digital economy, particularly in employment and education, and that's a very big plus. Agribusiness, it's a B+. Again, coming back to the temporary full expensing measure, very, very positive for the ag sector. For those businesses that are turning over, and not just in ag, but less than 50 million, you can also temporarily expense those full expense, second-hand assets as well. And I think that's a positive thing. And certainly with the primary producer, there's an increased class of assets that applies to as well, such as sheds and what have you too. Moving on to aged care and health, a very significant investment of $18 billion in the aged care reform package. That's so long overdue. It's wonderful to see that there. And there's also a lot more to encourage rural doctors, and including an increase in the bulk billing incentive there as well. Property and construction is a sector, maybe not directly in terms of direct measures, but will certainly benefit indirectly. From the $782 million over 4 years to increase home ownership and residential construction, to more significantly even the $15 billion over 10 years on road, rail and community infrastructure. I think a big tick. Education doesn't miss out either. There's a number of spending initiatives aimed at the education sector, and again, I think a tick there as well. Probably not quite as big as the ticks that we just saw, but still a tick. And finally, the mining sector. So welcome news that the junior mining exploration incentive is being extended yet again. It's been extended a couple of times, so we've got it again for another 4 years at a cost of $100 million. That's about it from me for now, but I'm sure you've got some good questions later.
Thank you for that, Steve. Some great stuff there. And once again, you can find some more detail in our budget alert. If you go to the comments section, you'll see the link there. Also encourage you to enter some questions in the Q&A section. Our next panelist is going to be Effie Zahos. Effie is one of Australia's leading money personal finance commentators, with more than 2 decades of experience helping Aussies make the most of their money. Best known for her former role as editor of Money magazine, having helped establish it and spending 2 decades there. Effie is now editor-at-large for CanStar, Australia's biggest financial comparison website. Known for her no-nonsense approach, she has a knack for making money matters simple. Welcome to our panel, Effie.
Thanks. Thank you, Andrew. And thanks, Steve. It was interesting to see your scorecard on the budget. I like how you laid that out. Look, it was interesting from, I guess I'm just going to put my consumer hat on here and stick to I guess, my pocket there. Interesting to be watching the federal budget. Unfortunately, when you do, when you watch a budget these days, most of it has all been kind of revealed. It's not like a big secret night where it's all laid out. So a lot of the stuff we kind of knew was coming out or were alluded, and it gave us time to think about it a little bit more. Put it simply, it rained. It poured last night when it came to what was coming out. We knew that the government was going to be spending, and I guess from a consumer point of view, it's like, where is this money? How is it going to be impacting me? Who are the winners? Who are the losers? There probably couldn't have been a better time to launch this budget. I mean, you had a situation where, you look at all kind of consumer confidence reports, they were on a high. We were $53 odd billion better off than what we were. It was kind of like, you've got a credit card, you've racked it up and you realise, hey, I haven't hit the limit yet. I'm going to keep on spending. So the government would have been very happy with the iron ore prices being so high. More people were in jobs than what they actually thought. So then that seems like, your tax and so on. So it was a good time. I think personally, they probably kind of under-promise, they're going to over-deliver, and for them, they're hoping this is an election winner. So I guess there was a lot happening there from a consumer side, more winners, as Steve actually said. I mean, you look at, I guess, first homeowners, the downsizers, you had aged care recipients, more winners. I think with losers, possibly from my side, it could have been renters. There was nothing in there. There was nothing, I guess, more for the job seekers. There were a few things that were missed on the super side. But all up, it was what we needed right now to capitalise on moving forward and growing and taking advantage of where we are right now. I think the key things moving forward for consumers, it's pretty clear if you've got money in a bank, your interest rates are going to stay rock bottom. They're not going anywhere. If you're looking at shares, then because of all this stimulus, the share market, especially the Aussie market, we've done so well, basically controlling the virus and handling on the economy side, that people are looking for value. So shares will continue to thrive, although, correction here and there is bound to happen, of course. On the property side, there were some announcements, as Steve mentioned, whereby will they impact the property market even further. Is that what we actually need? It seems like the policies they were putting forward was more about buying rather than helping with supply. And if it's a buying, whether that be single parents or being able to pull out more out of your super fund, that's going to cause more demand. So that, may have an impact that we actually don't want to see, putting further pressure possibly on prices because it's not helping on the supply side of things. For me, I was curious to see super. I'm very passionate about that. And I noticed it didn't rate so high on the poll. So I was upset to see that, but I'm going to push through super anyway. I know Abby's going to control my slides. So I had a bit of a problem. Abby, if you can get the first one up. I guess the big problem, if your super's under control, maybe you've got a younger child or something like that. I've got a 20-year-old that's very into super already at this age. About 36 billion was ripped out of super funds. So we know that. We know we rated our nest egg. So I was keen to see what is in the budget to actually help us build that nest egg up again. Three things that I just want to touch on quickly was the 450 threshold, that's been removed. The no work test for super top-ups for retirees, that's gone. That will enable us to put more into our super. And the downsize is that age limit has gone from 65 to 60, where you're able to sell your home, put the proceeds into your super, so long you've owned that home for 10 years. So those three measures alone will go a long way to helping, I guess, close the super gap for women or people in the gig economy on that 450. It'll go some way. I was disappointed that I didn't see super guarantee paid on parental leave. The government paid parental leave. That was disappointing. I thought that would come through. And to give you the impact, Abby, if you go to the next slide there, I'm sure you've seen these numbers. They can slice and dice different ways, but you can see the importance of why we do need to build this super up. So, for example, depending on what your scenarios use there, and you can see the whole disclaimer of what scenario assumptions were made. A 30-year-old who took out 20,000 could be up to about 70-odd thousand worse off, and we need to actually work on closing that gap. If I can get to the next slide, Abby, on that. So, is 450 the threshold? Removing that, is that the answer? No, that's not going to make us rich. It doesn't cost that much to actually implement. And I know there's been talk around, it was initially done because it was a compliance, and now we've got single touch payroll. It's easier to do. I think there's more to that. But to cut a long story short, this will go some way for people who have multiple jobs that are earning below that 450 threshold. And in this example here, just shows you that if you're, say, a 30-year-old and you've got multiple jobs and you're only earning 400 on each of them, in this one scenario, you could be better off by as much as 51,000. Now, that's not going to make you rich in retirement, but it goes some way to actually building that super. And I think this was kind of a low-hung kind of fruit to be taken and done that should have been done. But like I said, I would have liked to see the paid parental on the SG on paid parental leave. I was intrigued to hear that the Treasurer didn't really talk about the increase of SG to 12%. I mean, it's in the budget, that's going to happen, but it wasn't mentioned or made a big deal of. To me, that says a lot. Silence is golden. And it'd be interesting to see how that progresses further. I think the SG contribution going to 12% will go a long way to helping build that super. And what I found interesting is that the forecasts are showing that, don't expect a wage increase happening in the next 4 years. This may be the only way we got a wage increase through the SG jumping up to 12%, because looking at the papers there, noticed that inflation was going to be higher than real wage growth. So that was an interesting point to note. So for me, that the super missed some elements, but there were some good points to it, especially for retirees more so, on being able to downsize and scrapping that work test rule. I touched a little bit on the property side, that 2%. Abby, that slide can go off now. Thank you. And that's fine. The SG contribution, we can close that graphic. I touched a little bit on the property side of things. I think we'll find out more next week to do with that 2% deposit home loan. Interesting to note, CoreLogic just came out with some data this morning, and it's something that I would hone in on, that while a 2% deposit sounds great, you're obviously borrowing more. And on basic entry property prices of around 400,000, you end up paying, instead of having a deposit of 86, you only need 8,000 to jump in. Over 25 years, though, you are going to pay, a difference of around about $25,000 more in interest. So until we see more details around this, I mean, it is going through the bank's serviceability requirements. Responsible lending will still have to follow through, but it's an interesting approach they're taking. It will help a lot of women, though, because in a majority of cases, most single households are run by women. So it's a good way to get into the property market. But as I said, I'm a little bit concerned we're focusing more on jumping and driving demand and not helping with supply. Thank you.
Terrific. Thanks for that, Effie. Some excellent points there. And that point about the excitement of budget with all the leaks going certainly resonates with me. No more lockdowns and excitement of seeing it in Parliament House. We will have Effie's slides available for you, and we'll be sending those around after our webinar. Paul, some political aspects to this budget, so I'd be interested to hear some of your thoughts. I'm sure we all would.
Okay, Andrew. Well, you may notice that red is the new black. But I left my black T-shirt at home and joined the party. The budget is titled Securing Australia's Recovery, and it may surprise or not surprise you to know that the government's political opponents believe this is a budget to secure the Liberals' recovery and therefore win the looming election, which is due between August and May next year. The Prime Minister was asked about this today, and he said he's not thinking about this. He's not thinking about politics. He's only thinking about securing the recovery. And you might notice, because it's almost verbatim what he said on ABC TV this morning, that he didn't deny that he might go to the election when he believes he can best win it. And if he doesn't, we'd think less of him as a politician. I think the most insightful thing that we got out of the government, I was in the budget lockup. And at the budget lockup news conference, Simon Birmingham said the key assumption in this budget is that Australia continues to successfully suppress the virus. And the Treasurer sort of picked up the cue and he said, we don't know where this virus is going to take us. The other interesting thing, page 10 in budget paper number 1, you get what the Treasury says and how the Treasury explains what's going on. And the Treasury was very guarded in saying when the borders would open and when the vaccine would be rolled out. In fact, the Treasury said the program for rolling out the vaccine for everyone in Australia would be completed by the end of this year. Now, when the Treasurer and the Finance Minister were asked, well, what does that mean? Well, Simon Birmingham said it means that everyone who wants a vaccine will be double vaccinated by the end of the year. Now, this morning, when the Prime Minister was asked about that, he said, no, this isn't government policy. This is a Treasury assumption. Now, there's a bit of political cowardice in that because he doesn't want any benchmark or standard that he can be judged on whether he succeeded or failed. But the fact of the matter is that we are going to fail because we had a good week last week, according to the Health Minister. We had 400,000 vaccinations, but to get to that benchmark or assumption by the end of the year, a back of envelope calculation would be we would need 1 million vaccinations a week, starting now. So now the importance of all of this is the pandemic has taught us that health and the economy, that is how healthy we are and the economy are interdependent. In fact, if we've got thousands dying and thousands living in fear of dying or getting sick, it has enormous implications. That's why we have lockdowns. That's why we had the lockdowns last year. So the next point to make too about the recovery, there is no doubt, for example, that the red is the new black. If we start at $161 billion deficit in 2021 and we end up with a $57 billion deficit in 24-25, well, there is, at least at face value, fiscal consolidation there, but it's pretty mean, pretty weak, and it means that the idea of what was it in 2019? Frydenberg told us that we're back in the black. We're paying down the debt because we don't want to pass this debt on to our children and their children and future generations. Well, that sort of framing has gone. And the other reality, I think we should take both the finance minister and the treasurer at their word. All budgets, as we know, are assumptions. All budgets are best guesstimates. And all budgets are always hostage to reality. But this budget really is hostage to COVID in a very big way. Our economy and our prosperity is as well. The sooner we open those international borders, the better for the economy. And to do that, we really do need the federal government to get quite serious and urgent about genuine quarantine arrangements to allow Australians to come home, 36,000 at last count, 9,000 alone in India, but more to the point, to allow thousands of fee-paying students back into our universities and colleges, and of course, foreign tourists. We're basically bleeding billions of dollars there, and that will have an impact. So that's a bit of a broad view. So far, what we've seen and heard this morning is pretty comprehensive and pretty impressive. So, Andrew, I think I might leave it at that.
Thank you very much, Paul. I think it's very easy to forget with the level of economic prosperity and certainly the outlook in the budget that it does rest on the continued health of the nation. So I think some fantastic points there and very well made. So Serena Lacey is our next panellist. Serena has over 20 years experience providing economic policy analysis and advice. She's led a large number of consultation programs and delivered evidence-based advice in Australia and internationally to drive change in how governments invest in health and other human services. Welcome to the panel, Serena.
Thanks very much, and thank you for having me. I'm just going to share my screen now. Hopefully you can see this. I guess I wanted to give you, an overview of the budget from an economic perspective. And I think the main thing that, economists will look at the budget and have to try and package the measures into is the extent to which it really is building resilience for the economy. So the things that you want out of a budget are things that are well targeted, that achieve their objectives and actually are positive for building a productive economy and a socially cohesive economy. So I guess when we think about, the last budget, there was a lot of sugar in that. There was a lot of money spread around. This is another big spending budget. But this time, I think we're seeing a lot more some resilience building, which I think is really important. So if we think about economic resilience building, the key things that we see in the budget, well, first thing, resilience building is always about reform. I mean, you could blink and you miss it in this one, but there is a big one there in aged care reform. Steve, you mentioned earlier, there's no tax reform. I mean, that is a bit of a shame because it's a golden opportunity to have the funds to be able to strike that deal at the moment, but it wasn't there. So the reform bundle, it looks a little bit small, but it is there, and it really is important to get expensive, hard to do stuff through at a time like this, and we're doing that in aged care. And there's a whole range of measures that we are around strengthening employment, and they are particularly around strengthening private sector employment. So that's something that we're not seeing bigger government necessarily with this spending. We're seeing a channeling into generating stronger, more resilient private sector employment opportunities. And there are a range of different ways that's being done. I think the childcare subsidy is in there as part of that. Obviously, a range of apprenticeship subsidies, specific subsidies to assist in particular opportunities. And obviously the digital economy strategy I put in there as well, because that's really about attracting investment and jobs in that sector here, which is obviously a good long-term strategy for Australia. On the social resilience side, kind of packaged up kind of whole range of health and equity measures within that. So a lot of the big spending opportunities around community building are really important, expensive things that need to be done. So there's quite a lot of spending around COVID-19, particularly the vaccine strategy and all the support measures, the testing, all the stuff that goes into that. Great to see nice, good spend around mental health. That's been something that's really been expensive and hard to do for a long time. Finally getting some traction there. Around equity, these are the sorts of things that are important to address the income distribution question, particularly in the current environment when the winners and losers have always been there, but they're even more there at the moment because it's just with the turbulence around what's happening with COVID. So there is quite a big amount of spending in that. And when it comes to the sugar hits, they're quite specific around certain groups. There's big spending around aviation and tourism sectors, obviously the big losers because of COVID. The rail and road projects have already been mentioned. That's a big spend around infrastructure, but it's around projects that have been wanting that sort of investment for a while. So there's definitely some sugar to be spread around, but this time around it's a little bit more focused, which is good to see. I just wanted to provide a little bit of context around the size of the net debt position, because it is, this is a big deal, right? When you talk to economists about, looking at what the government net debt is at the moment, we just haven't seen these sorts of levels. So this slide takes us back to the 1930s and looks at all kind of different developments around the economy over that period of time. And the red bars to the right-hand side, this is our forecast net debt position. So they've been revised down thanks to a little bit of happiness around the iron ore price to be, peaking at just under 41% of GDP. That's still a really big number. We just haven't seen that before. So in terms of that context, we really need to take this seriously because it is unprecedented, and it's a level of government debt that hasn't been seen in history, and it's better than was thought, thanks to the economic recovery that we've seen. The other thing I wanted to mention around understanding the budget in the economic context is the recent economic times are just not normal when it comes to crises. GDP has been just so jerky. I mean, we just haven't seen this before. So, we had a collapse in the June quarter of 7%. That was the largest quarterly change in real GDP ever recorded. Then we had this huge bounce back in the September quarter and in the December quarter, both in their own right, extremely huge swings, the sixth and the largest we've seen. And we've never seen two successive quarterly changes in GDP that have been above 3%. So, and you can see kind of one of the things that's driving that little chart there, a bit hard to read, but that's our strange spending patterns over the last year. I mean, it looks like someone's having a heart attack on the ECG. So you've got wild fluctuations in transport and in hotels, cafes and restaurants, and you've got things that are always staying high like alcohol and household goods and anything you can do at home, right? So it's just a change in spending that we just really haven't seen before. And it's just, it really is, it's been hard to predict and hard to manage, and it's resulted in, I think, the way that the budget has been positioned as another, don't know yet, still needs to be a high spending budget. The other thing I wanted to mention in terms of context is that it's unemployment that's a really big driver of the government response. And that's really important too. I mean, people have talked about it's monetary policy is being loose, but people have talked about that impact on house prices, but even that really is an unemployment targeted measure. So this again takes our unemployment rate data back as far as we can take it, which is to the late 70s. So you can see this, this COVID pandemic over on the right-hand side, it leapt up to levels that we haven't seen since the GFC. And there was fears that it might get as high as 15% if nothing was done. And, that kind of would take us off the chart. That would take us higher than we would have been during the stock market crash and recession of the late 1980s. So we had that, really sizable $311 billion fiscal stimulus to bring that back. We've seen the unemployment rate come down as a result. And if this chart was of, changes in employment, changes in underemployment, changes in labour market participation, they all tell this nice rebounding story. So the spend has very much focused on unemployment. and the packages around the measures are all kind of targeted at that. So when we're looking forward, the budget outlook is really looking at a sustained rebound. I mean, Paul mentioned earlier some of the assumptions in their budget that are really important. To get the results that the government is forecasting, we are assuming that there are going to be no more, or there are going to be no uncontainable outbreaks in COVID. We're assuming that there is going to be a population-wide vaccine program in place by the end of the year. There'll be no sustained or extended state border closures. And importantly, we're going to get a return to migration in mid-2022. We really need that within the Australian economy. We always have a skills shortage problem for a range of different reasons. And migration is really key to economic growth in Australia. So these sorts of promises in the budget around a return to sort of stability and strength do require this kind of business as usual around COVID. So just in summary, you know, it's absolutely not a standout budget of reform, which is a bit of a shame because there's a lot of money and money is not expensive at the moment, but it is what it is. And I wouldn't say it's the budget that we had to have, but I'd say it's the budget we were always going to have. You know, I had to continue to be sympathetic to the COVID pandemic. It's not over yet. It's too soon to call it over, but there are obviously some signs of some pre-election positioning there. The one thing that I guess I would highlight as a risk going forward is that, you know, these stimulus measures will expire. I mean, the reduction in the deficit has already been mentioned. Part of that will be growth driven, but part of that has to be expiry of stimulus driven. And it's very hard to disinvest, and it's very hard to take away some choices in the budget that can prove quite sticky, like, you know, offsets. You know, we haven't got tax reductions, we've got offsets and they expire and then people's tax rates go back up again. So I guess that's just sort of one to watch. So I did have just a quick poll question, which I might ask just to be brought up now. So this, I guess, is, you know, given that if we're thinking about the state of net government debt, I just want to get a sense about what your views are about, you know, whether you think it's about right, too high or too low. So, you know, we're currently looking at 34.2% at June 2022. We're going to peak at 41% of GDP. That is a big number. You know, what do you think about that? I mean, do you think it's, you know, about right given where we are with the pandemic and the state of the global economy? Is it not high enough given the challenges that we've got? Or is it too high and time to, you know, let's start thinking about budget repair? We might close that one off and see what the room thinks. About right. So I think that's probably the general consensus that comes through today. So back over to you, Andrew.
Terrific, thanks for that, Serena. And look, I don't envy yourself and your colleagues at the Centre for International Economics trying to do your job in such uncertain times. We're getting new rules written all the time. Thank you to all of our panelists. We've had some questions come in, so I will start asking a few questions to panelists. My first one is to Steve. And Steve, at risk of you putting you back on your soapbox, mate, you did mention that the budget didn't deliver any tax reform, but the question is our tax system fit for purpose for the modern economy?
Steve, we can't hear you, on mute.
Sorry, my bad. Excellent question, and yes, you've got me back on my soapbox, Andrew. So I appreciate that, and I appreciate the questioner. I think the answer is quite simply no, it's not. I mean, we've got the modern economy. At the core of it is a great mobility of capital and labour, and particularly intellectual capital. And the measures that we saw in the budget around the patent box, they are really good measures that are taking us in the right kind of direction. But at the end of the day, we're still not necessarily competitive even with that regime with some other countries, as I mentioned with Singapore. We've got to be mindful that capital is only going to be more and more mobile going forward, and capital, of course, it's more intellectual capital, it's knowledge, and so is the best tax system one that relies on income tax and taxing, you know, capital and labour? And I'd be interested probably in Serena's view too. My view is absolutely not. We'd never go near that sacred cow called the GST. And it's one of those things where if we want real tax reform, we have to go there. I think, and I will shut up in a moment, Andrew, but you did open the Pandora's box for me. Back in 2015, I remember the Federal Treasurer Joe Hockey at the time released his rethink paper. And at that time, we had great expectation that we were going to see real tax reform. At the time it was released, it was nothing is taken off the table. And within probably a couple of weeks, there's, oh, well, you can't go near negative gearing and you can't go near dividend imputation and you can't go near GST. But apart from that, nothing is off the table. So long-winded answer, no, it's not fit for purpose. Yes, we need real structural tax reform. As Serena and Effie both said as well, I think we're all in violent agreement. This is the time we could have done it. You know, we're swimming in cash. We've got a wonderful iron ore price that really supports our economy. Why can't we actually achieve something like that now?
Thanks for that, Steve. Paul, you would remember the days of Dr. Hewson's birthday cake and the danger of tampering with GST or explaining it.
Indeed.
But a question for you is how likely is an election this year? I mean, are we looking at a pre-election budget here, in your opinion?
Well, earlier in the year, the Prime Minister said there'd be 2 budgets before the next election. So we've had one, and that would mean that there'd be, I mean, it's a tricky pull. You might remember before the last election, he had a budget and then went straight to an election campaign. And that budget went a long way to help him achieve that miracle win. Look, Scott Morrison, if he's nothing else, is a fairly wily politician, and he'll go to an election when he judges it's best in his interest. As I said before, a lot of his backbench believe that he will go probably sometime this year, maybe around October. As I said to you earlier, the Prime Minister himself has given a pretty fuzzy answer, but trying to suggest that it'll be next year, which begs the question, if they've done this year, next year's going to be a definite pre-budget, pre-election budget. You wonder what the hell they're going to pull out of that.
So there may not be as much cash to splash around next year.
Or even more, imagine that.
So thanks for that. Serena, a question for you, and we've got a bit of government speak that needs clarification. It's been noted to us that the government mentioned using the government's balance sheet to support productivity enhancing investments. What does this actually mean?
Well, it should be investing in the sort of things that Steve has just been talking about. So the things that make labour more productive and the things that make capital more productive. And so it's around investing in the things that upskill labour and investing in the things that make us more innovative and more productive, and perhaps not doing the things that detract from that. So when you're doing reform, trying to be careful with how much you compensate for reform. And so when you're doing reform, you take rid of the exceptions and the things that kind of trying to undo what you're trying to achieve with that reform. So if you're doing it, if you're using the balance sheet to strengthen the economy, you're using it to invest in employment, resilience building, the efficiency of capital, making Australia a more attractive place to invest and to grow from.
Do you believe this budget is achieving those aims? Are we actually spending well in this budget to achieve future growth and productivity for our country?
So is it a good investment? There are good investment bits in it, but I wouldn't say it's the best investing budget. If it was the best investing budget, it would have done more with the opportunity of the cash and the willingness of the community really to make big changes, because we really are living in kind of unprecedented times. But there are some good things in there. There's good economic resilience building measures, and there's good social resilience building measures, but there's also a lot of lost opportunity as well.
Okay, thank you for that, Serena. Effie, the RBA says cash rates won't move until unemployment is below 5% and inflation back to that 2 to 3% range. Mm-hmm. Do you see this encouraging spending to support growth?
Clearly we are borrowing more when you look at the amount of commitment in home loans. That's had a huge trajectory going upwards. But yeah, while that is the case on the cash rate and the funding there is cheap, what I'm seeing though, 4 and 5 year fixed terms have already gone up. So for consumers wanting to kind of, I guess, lock into these rock bottom fixed rates, they're moving fast in the sense of the long-term fixed rates. And there are a number of reasons why that's happening. But I'll give you an example. Even today, NAB has just increased its 4-year and 5-year fixed rates. You could have locked in for 4 years at a rate below 2%. I think it was about 1.89 or something like that. 4 years at that rate, which is crazy. Now, NAB was the last one to move. It's just made an announcement today that it's increased 4 and 5. And I think what we're going to see is those long-term fixed rates. The market's already factoring that in. However, short-term fixed rates and variable fixed rates, I'm still seeing those fall and seeing quite a lot of variable rates still falling and shorter term fixed rates. And that's just the competition within the market at the moment. I think consumers need to weigh up and obviously work in a decision that works for them. But if they're wanting a long-term fixed rate, then I guess those rock bottoms are moving. Understand, if I was going to lock in, I'd probably ask my lender, can I make extra repayments? In most cases, you can. You can hedge your bets, you can split your loan. In most cases, there's no fees. Just find out the ins and outs before you do commit to yourself. Because obviously, if you want to sell that property because the property market's up and you've locked in, you're going to find a big, nasty fee to get out of that. So I guess the tip is, if you're looking for long-term fixed rates, 4 years, 5 years, move fast because they're already moving. Short term, you still have time, of course, on your side.
And while we're on property, do you see the initiatives in the budget, such as the family home guarantee for single parents, stimulating entry to the property market, and the super changes as well?
Yeah, look, because until the details all come out with that 2% home loan deposit scheme, I don't know if it's going to be capped on certain property prices. It is limited, I believe, to 10,000 anyway. I feel that, combined with the ability to take your money out of super up to 50, will naturally place more demand in a very heated market. And, you know, this has been discussed for a while. I think property has been bulletproof to a certain extent. And I don't mean that in a good way too. That whole fear of missing out has really caused people to jump into the property market. And we've got to realise, I just said now that long-term fixed rates are going up. We will see rates turn around eventually. So it's that overcommitment. I feel, like I said before, a lot of the policy changes were all still about jumping in and buying property and not really addressing supply. So it's a basic economic thing, demand, supply. It's going to put pressure on prices. And there's no doubt about it. But how much is yet to be seen, because these, again, are very targeted measures. But we know how much, you know, the first home loan deposit scheme, that 10,000 placement of 5% deposit only required, and the government putting in the rest, that had a huge impact on the property market too.
Yeah, thanks for that insight. Serena, a question has come through around what is the total financial impact on COVID-19? What impact has it had on the Australian economy in terms of dollar value?
Look, it's a good question. It's not a question to answer easily. The easiest way to answer it is to use the number that the government gave us last night, and that is that they've spent $311 billion on it. And that's a big number. We know of that. There's been about $25 billion directly spent around the health response. So that's everything from sorting out testing and vaccine delivery in aged care, medical research into vaccines, vaccine purchase, the rollout, etc. So you got 25 billion there, and then 311 less that 25 on the rest. So that's all of the economic stimulus packages. But in some sense, it's bigger than that, because, you know, we've also got, you know, obviously a deficit in the cash position of $161 billion as well. And part of that is going to be, you know, a revenue loss from a lack of employment and from underemployment that kind of occurred during COVID. So it's at least 311 billion. But then, you know, is that a good number? Is that a big number? Is that a small number? I mean, Australia's made its own kind of decision as to how to balance its health and economic priorities. And we're just very lucky as a country that we were able to probably get away with that kind of a spend with the kind of result that we got. So I think there was a little bit of luck in that as well.
Yeah, terrific. Thank you. Steve, the government, should the government legislate an increased instant asset write-off or temporary full expensing, make that more permanent? What's your view on that?
Sorry, I'm just.
Still got you on mute there, Steve.
All right, there we are. Now you can hear me. Look, I think there's a lot of validity in that because what we have seen in the short term that has been in place is that it really has driven, capital investment. I think in a situation where we do have a relatively high corporate tax rate, relative to our counterparts in the developed world, and that's part of the whole tax reform agenda that I was referring to. If we can have initiatives like that have become a more permanent feature of our taxation system, that helps us achieve a better effective tax outcome. And it also helps to, I guess, drive the right behaviour. So, initiatives like that, not only do they, I suppose, generate production in the economy, they also drive the behaviour that we want to drive. So, look, I think absolutely, I'm a big supporter of making those sorts of things more permanent.
It certainly makes tax planning a lot easier. Paul, a question for you. Has this budget done anything to lower our dependency on China, especially iron ore sales?
Well, if anything, it's just proved how dependent we are on China. I noticed that a number of economists, for example, Deloitte Access Economics, are saying that the iron ore price can't stay up at over $200. In fact, they're forecasting it'll start coming down. We'll notice that. Don't forget, we've got the loss of our agriculture markets. $200 billion worth of Australia's agriculture went to the United States. That's where China's buying its wine and its grains. Which raises all sorts of interesting and worrying questions. Look, I think we do have to realise that China is now, if not the biggest, close to the biggest economy in the world. There is no one else that can afford to buy what it buys in the volume that it buys it. And I would hope that that our government, our diplomacy is a bit more realpolitik, because there is no doubt our prosperity will depend on us getting on much better with our biggest trading partner.
Thank you very much, Paul. Well, we've got time for one final question. And Effie, I'll direct this question to you. Retirees were seen as winners. Do you want to expand on that or give us some views on that? Effie, you may be on mute there.
Yep. Sorry about that.
Thank you.
Yeah, retirees have had it very tough over the past 12 months. There is absolutely no denying that. I mean, when you have record low interest rates, when your bank account's paying you next to nothing, then you either have to cop it and try and survive it or dial up the risk. And dialing up the risk is something, when you are retired, is not what you want to do. So it's been really hard to actually get a return on investments. So it was nice to see that there was some changes within the budget, to address some of these issues. Did they go far enough? Well, I mean, on a personal note, no. I mean, have a look at the pension loan scheme that they're doing to improve. Like the fact that you can actually get a lump sum payment out of it, which is great, but it's still being charged at 4.5%. Now that I don't understand. If I can pick up a home loan at 1.9%, why is the government charging me 4.5%? So that's interesting, why there was no movement on that. But the product was improved because eligible people, they'll be able to receive a maximum lump sum advance. And I've just got the note here, up to 50% on the maximum age pension. So that's some nice equity that they could get into. Of course, there are pros and cons with pension loan schemes that you should really speak to a financial advisor about. And the other one was that you don't have to now do that work test to add to your super, so you can still do that. And the downsizing is a great way to put money back into your property, and it's not counted as part of your caps, which is at 1.6 million at the moment, and I believe it's going to change to 1.7 on the 1st of July. So look, there are a few things there that the government is proposing that can boost super balances. But again, all this assumes that you do have a property, that you are in a position to take advantage of these moves. So look, it's been a hard trot for them over the past 12 months. Anything is better than nothing. But again, it is for a very targeted audience.
Well, terrific. Thank you for that, Effie. And we've come to the end of our time for our webinar. On behalf of RSM, I would like to thank all of you for attending our webinar. And I would like to thank Effie Zahos from CanStar, Paul Bongiorno for joining me here in the studio, Serena Lacey from the Centre for International Economics, and Steve Healy from RSM. Thank you to all the panellists, and thank you for taking time out today to listen to our webinar. The slides will be available from all the presenters, as well as the budget alert, which you can get from the RSM website, or you can follow the link in the comments section just before we close up for today. Once again, thank you for your time.
Thank you.